Hello, we're the Profitables, and this is our analysis on Nike versus Adidas. I'm Jaslyn Miller.
I'm Nadia Joseph.
And I'm Nyla Day Johnson. Prior to this project, I thought that Nike's financials would be better than Adidas simply because I see more Nike endorsements than I do Adidas.
I believe that Nike would outperform Adidas due to its popularity and the market.
I also believe that Nike would do better than Adidas just because it seems like the bigger brand.
My name is Nyla Day Johnson, and I will be talking about the company background. First, what we're going to get into is what is Nike. Nike is a multi-billion-dollar company that focuses on athletic footwear and apparel. They also focus on empowering athletes, and they send the message of breaking down any barriers that are before you. They are known for their Just Do It slogan and their iconic swoosh logo. We're going to get a little bit into the background of where Nike started. First, in 1974 is where they started the launch of the waffle trainer, and it was originally named the Moon Shoe. Ironically, this shoe was started from a waffle iron, which is a kitchen appliance, which is crazy. It was an improvement from the Cortez, which Nike had worked on, but it wasn't technically their own shoe. In 1985 is when the Air Jordan 1 first launched. The Air Jordan 1 was a collaboration with Michael Jordan when he was first entering the league. They had gave him multiple incentives to collaborate with them. As they sent the incentive of 2 Mercedes-Benz, $500,000 a year for 5 years, and the shoe was in red, black, and white. This was a problem for the NBA because the NBA had the status quo of only white basketball shoes. This specific shoe brought attention to Nike and Michael Jordan in general. Going to 1988 is when the Just Do It campaign had launched. The Just Do It campaign was their first commercial, which had showed an 80-year-old man running multiple miles over the Golden Gate Bridge. It gave the message to break down any barriers before you and that any athlete of age, gender, or disability can just do it. In 1989 was the Bo Knows campaign. The campaign had Bo Jackson, which was a multi-sport athlete, in a commercial doing multiple different activities with Nike apparel and footwear. It gave the message that Nike can be sold to all athletes no matter the sport and no matter what activity is being done. Moving to 1990, we have Nike World Campus. It was their first campus and was located in Beaverton, Oregon. They chose a specific location because they wanted a creative workforce, which they thought Oregon had brought, and it was also close to the transportation hubs. Next, we have Nike versus Adidas. Everyone knows that Adidas is Nike's biggest competitor, so let's look at what makes them similar and what makes them a little bit different. Starting with Nike, we have that they have memorable campaigns, athlete collaborations, and technological advances such as the Flyknit technology and Nike Foam React. Going to Adidas, they also have the memorable campaigns, the athlete collaborations, and they also have Beyonce as an endorsement. They also have technological advances, which they consider the Boost cushioning and the Prime Knit fabrics. Different from the two, the message that Nike sends is to push athletes to be great and empower them to achieve greatness, whereas Adidas emphasizes individuality and authenticity.
My name is Nadia Joseph, and I'll be talking about the financial ratio analysis of the companies Nike and our competitor Adidas. To begin, we found the ratios for liquidity, which included the current and quick ratio for Nike. A liquidity analysis was found, and it's basically something that companies use to see how fast they can turn their company into cash or use it for a short-term obligation. Nike's current and quick ratios were consistently higher throughout the timeline than the average, but Adidas's quick ratio in 2022 was slightly under, around 0.622, which was reaching the average current ratio numbers. And in 2021, Adidas experienced a quick jump in both ratios, while Nike saw a slight increase and it continued to rise after. And both companies experienced a jump in ratios ranging from 0.3 to 0.5, but they soon followed by a return to the previous year's numbers. And it's important to note that in 2020, the pandemic happened, so this significantly impacts the numbers that we got for that year. The next ratios we found were the efficiency ratios. We used the accounts receivable turnover, the inventory turnover, and the average age of inventory from both Nike and Adidas to find it. And the efficiency ratio measures how well a company uses their assets to generate sales and profit. And in 2023, Nike's accounts receivable turnover increased to 12.39, and it indicated an efficient collection of outstanding receivables. Inventory turnover improved from 3.94 in 2023, from 3.44 in 2022, and 2.88 in 2019, showing a rapid turnover, showing that Nike manages their stock of goods pretty well. The average age of inventory decreased in 2023, indicating improved inventory and time management. While Adidas's ratios were generally lower than Nike's, the accounts receivable turnover at 7.89 and the inventory turnover at 2.43 in 2023 showed that they were lower than Nike. And the average age of inventory for Adidas is consistently higher than Nike's, which possibly can lead to higher carrying costs. The third set of ratios that we looked at was the debt ratios. This is the debt ratios, the debt to equity, and the long-term debt to equity for Nike and Adidas. The debt ratios are really just going to measure the debt a company has in comparison to its assets. For these numbers, Nike's lower debt ratios indicated a conservative leverage and a healthier balance sheet, and Nike had a much lower ratio at 0.187, while Adidas's was at 0.308. Nike's lower debt to equity ratios suggest less reliance on debt financing, reflecting financial stability. Adidas had high long-term debt to equity ratios, and it indicated potential higher reliance on long-term debt, and it impacted the financial risk that they have as a company. Maintaining lower debt levels would allow a company like Nike to focus on their growth and their financial resilience. The last set of ratios that we calculated were the profitability ratios, and this is just going to be measuring the profit from the assets and the revenue. We used the total profit margin, the operating profit margin, and the net profit margin from both Adidas and Nike to get these numbers, and we found that Nike's profitability ratios were generally outperforming Adidas's, and Nike's total profit margin was consistently positive, while Adidas had fluctuated with their numbers, even turning negative in 2023. Nike's operating profit margin showed a decreasing trend, but it remained higher than Adidas, indicating better operational efficiency. Both Nike and Adidas experienced negative net profit margins in 2023, Adidas at negative 0.005, but Nike's downturn was less severe and it only went as low as 0.099. Despite the challenges, Nike maintained to be a stronger financial position in comparison to Adidas.
My name is Jaslyn, and we'll be looking at the cost of capital. Capital is the money a company raises in order to do business. Why is the cost of capital important? On the investor standpoint, it helps them decide if an investment is worth investing to. And from the company standpoint, it helps them decide how much profit a project must generate after raising the money to implement the project. How is this done? Using statistics and ratios. The financial ratios used for the cost of capital are the after-tax cost of debt, cost of preferred stock, and the weighted average cost of capital. The after-tax cost of debt is interest owed on the money a company's borrowed. The cost of preferred stock is just like the name. It's the price a company pays in return of the income generated from selling stocks. And then we have weighted average cost of capital, which is abbreviated as WACC. It is the rate a company expects to pay to allocate for the financing of a project. And I say project because both Adidas and Nike are already well-established companies. So when they're raising more money, it's not necessarily to finance the company itself, but new projects that they want to implement. Let's start off with the after-tax cost of debt. And here we have Nike in blue and Adidas in orange. In 2019, Adidas interest that they're paying on the money that they borrowed is way higher, not way higher, but substantially higher than Nike at above 4%, closer to 5, closer to 6. And then Nike is under, just below 4%. In 2020, this number goes down, and this has a lot to do with COVID. There wasn't many operations that they could have during COVID, so they didn't need as much money invested. 2021, the rates go back up. The economy needs to adjust for the hit that it just took with COVID, so the interest rates are rising back from where they were during the COVID. 2022 is the same, and then you have 2023. It's not as high as the numbers in 2019, but as you can see for Adidas, it is under the line. The fact of the matter is, you can't have a negative after-tax cost of debt. What this really means is that Adidas paid more in interest than what it really borrowed. Moving on to cost of preferred stock. You only see Nike here because Adidas paid a dividend in an amount of $1.16 in December, but there is no record of what the preferred stock is currently priced at, so it makes the equation null and void. For Nike, they had a better price of preferred stock simply by default. Adidas didn't have key information needed to go into the equation. So in 2019, they were paying 2.2% of what they made onto the preferred stock. And it goes up a little more, up higher, drops way down in 2022, and then it reaches way higher than it was before in 2019. This is because Nike is starting to borrow more money because they are implementing and re-strategizing their company. And with rebranding comes new projects, which comes more money needed to raise for capital. Lastly, we have the weighted average cost of capital. Again, capital is money raised in order to continue operations. Equity is the money raised by borrowing from or getting money from owners and shareholders. Debt is the money and capital that we get from banks and other sources. When you borrow from a bank, they give you an interest rate. The interest rate is the cost of that capital. But for equity, the cost of the capital is the expected return. So let's say you borrow from a bank, but you also raise money from shareholders as well. How will we know how much interest we're paying on what? We use the weighted average cost of capital. This is the cost when using both equity and debt to raise money. So in 2019, again, Nike is in the blue, Adidas is in the orange. In 2019, you see that it's at 2%. So that's the average of interest that is paying on the money that is borrowed. Right here you have Adidas at just below 2%, around 1-something%. It's more accurately specified in our Excel calculations. Here you have a steady flow. It stays the same pretty much for Adidas, goes down in 2022, but then it starts to shoot up in 2023. There's a difference for Nike. It's showing you that it is shooting up, it kind of has a steady flow, and then it comes right back down in 2023. Based on this, the one that is doing better is Adidas, and that's because they are not paying as much interest on the money that they are borrowing. And again, this is because Adidas is not as big of a company as Nike is, so they don't have to borrow as much money to keep operations going. And then Nike is also rebranding, so they're going to borrow more money, which is going to make them have to pay more in interest. Thank you.
Coming to the conclusion, we see that these financials show who is the overall better company to invest in, as well as what future growth the company may have. Market trends are the most impactful for the finances, as well as the internal company decisions. The pandemic is also a major factor into the financials of 2020 and the years following. The numbers following 2020 show how well the company is able to bounce back from the pause of operations. From the time of research about Nike,
We followed Nike's news and trends, which helped us determine why their numbers were fluctuating so much. And at the end of our research, we have concluded that Nike is still the better company to invest in based on their finances since 2019, as well as how well they are established in the market and the industry.
Thank you.